Welcome back to Trading Hour. Varun Lohchab from HDFC Securities joins us now to discuss market fundamentals as well as his top sectoral picks. Welcome, Varun, to the show. Thank you so much for joining us. Post Q1, you've made quite a few important changes as far as your own model portfolio is concerned. Can you take us through, which are the top ones, especially in the consumer space, and what is the rationale behind making these changes? We see that you've added Jubilant Food, but on the other hand, you've actually taken out of Britannia. So, what is the rationale for these changes?
Yeah, hi, good morning. So see, overall, we have been making a few changes to our model portfolio every quarter as, risk reward on various sectors and stocks keeps moving. And in a market which has been trending up, it has been moving quite sharply and in a short span of time. So generally in last 6 months, what we have been doing on our model portfolio is as follows. One, we have been cutting down on industrials and real estate where we were significantly overweight for 12 to 18 months prior to that. And we have been adding all three sectors, which is IT, banking, and consumer staples. Three sectors where we were underweight over last, again 12 to 18 months prior to previous 6 months. So if you'll see even the Q4 changes in terms of our model portfolio, we had added some more consumer staples. Now, for the first time in 4 years, we have gone overweight on consumer staples. Consumer durables, we had turned overweight 6 months back itself. Banking, we are still neutral, but we have been increasing our weight and going from underweight to neutral. And IT also, we are close to neutral right now. So this is broadly the sort of changes we have been making. In terms of specific stocks, as you asked, Britannia versus Jubilant, it's more a question of individual companies' risk reward. We believe Jubilant probably provides a greater medium term upside given the fact that SSG is now bottomed out in our view and should improve from here on. Our analyst has also turned constructive on that name. So that's the rationale. Britannia we still continue to like. So we have an add rating on Britannia, but a buy rating on Jubilant. So given the greater upside in Jubilant, we have added that one.
Let's talk a little bit, Varun, about Emphasis. Emphasis has been an outperformer in the last 3 months. I think in the last 3 months, Emphasis has gone up nearly 30%. Now, the key narrative playing out here is that the rate cutting cycle in the US will result in a recovery in their mortgage segment. So the same segment which led to the underperformance over the last 2 years will start, outperforming. And anyway, spending by large banks in the US is showing signs of a recovery. We saw that in Q1 as well. So why are you trimming your position in Emphasis? I understand the recent, outperformance in the stock, but is that it, or are there any other concerns when it comes to Emphasis?
So not overly concerned on Emphasis per se. If you'll see the changes, we had 2 stocks, Tech Mahindra and Emphasis, where we were overweight in the last 6 months in IT. And we have now actually trimmed our positions in both of them and actually added TCS, which is our top large cap pick. So in that sense, what we are also seeing is while recovery, as you rightly pointed out, is looking to be the base case scenario, especially in case of Emphasis verticals, our analyst does not see much upside from current levels, whereas on TCS, he still has an upside and a positive rating. Plus, large cap IT to us looks better placed compared to mid cap IT at this juncture, given the valuations versus the growth sort of outlook. So it's again very bottom up, but IT overall, you would see that we have maintained our weight in this current quarter. We have exited some mid caps and added some large caps in IT.
Just getting back to the markets per se, before we delve into other sectors and stocks, your projected earnings growth for FY25 is just 5.7%. I thought market expectation is that at least we will have, low to mid double-digit kind of growth this year. So just 5.7%. And is this not a cause, if we are going to see some earnings downgrades, is that not a big cause of worry?
Yeah, so see, you can look at it both ways. If you look at this 5.7% is for our coverage universe of around 230 stocks, which has both large cap, mid cap. Now, what is pulling it down in, is actually OMCs, which had a stellar earnings last year. So if you X out OMCs, the number for even FY25 is close to that low double digit, 10 to 12% kind of a CAGR. And on a 2-year basis, what we are projecting for our coverage universe is around 11% CAGR. So net, I think the way to think is still more, that I think India Inc. corporate earnings will continue to grow at around 10 to 12% CAGR for next couple of years. But it's a significant sort of a moderation from a high teens kind of a growth which we saw in the previous 4 years. So, and therefore the return expectations have to be moderated given the fact that, valuations are looking stretched. And let me, while headline Nifty PE may not look overly stretched, we just did one analysis which I thought was fairly interesting. If you look at in FY19, Nifty PE was around 21, 22 times, and today it is around 25 times on trailing basis. But in a 5 years time, banking sector has got derated by almost 50%, and therefore, now the banking sector PE is at 17 times. And if you look at ex-banking, that has got re-rated by 50%, and now the PE stands at 30 times. So therefore, while headline Nifty PE may not have changed a lot, there has been a lot of changes within that, and therefore, one has to be cognizant of of the fact that right now almost 70% of stocks in Nifty are trading above, significantly above their long-term average valuations, which means that at some point, returns will get moderated, just the way it happened in banking. If we go back 5 years back, when rest of the market was available at a significant discount to banking sector, which was trading at 35p in FY19. So it has completely reversed in these 5 years, and from here on, again, we are seeing that the market is positioned on one extreme where the entire industrials and the infrastructure theme and all is priced to perfection, while we are still believers in macro story and fundamentals being good. We believe the stock returns will be moderate from here on in some of those segments.
Right. So you've gone underweight as far as industrials are concerned, but moving to what is essentially a very large weightage as far as the Nifty is concerned and even in the broader markets, let's talk about the BFSI space. You said that returns here have been quite moderate over the last 5 years. From this point on, how do you see the banking pack especially move, and which will be your top picks over there, and where do you stay underweight?
Yeah. So in case of banks, still our preference is for large banks over small banks, and still largely for banks over NBFCs, but we have got actually both in our model portfolio. So in terms of the key picks, it is ICICI, SBI among the large banks, and Federal Bank among the mid-cap banks. So these are the three large picks. And in NBFCs, we like Chola, we like Aavas. So yeah, these are some of the names which are there in our model portfolio. As far as banking sector goes, as I said, now valuation part is corrected, and now it's at a 30% discount to Nifty versus 50% premium to Nifty, which it used to enjoy 5 years back. But at the same time, I think near-term earnings will remain muted in case of banking for next 6 to 12 months. So which means that maybe you may not see outperformance from this segment straight away, but from a medium term, we believe the risk reward is looking very healthy in case of actually both private and public sector banks. The large public sector banks are also looking fine to us, and the large private sector banks are also looking okay.
Okay. Thank you, Varun, for joining in. That's the view on the markets from HDFC Securities.